Good day, everyone. I am Gwendolyn F. Caldana, and we are the Group 4 reporting Financial Structure and Corporate Governance. So today, our objectives are to define what is capital structure and financial risk. Second, to determine if the capital structure does matter. Third, to define what is the agency cost of debt. And fourth, to determine whether what is meant by employee as residual claimant. So this chapter examines corporate financial structure decisions and some of their implications for shareholders, the debt suppliers, other stakeholders, and corporate governance practitioners. The most obvious consequence of financial structure decisions is their impact on corporate financial risk, that is, leverage increase the variance of residual cash flows accruing to shareholders. Such simultaneous changes in business risk and financial leverage have the potential to significantly alter managerial incentives and the distribution of financial risk between different corporate stakeholders, primarily from shareholders to debt holders and employees. Jensen and Meckling argue that given reasonably efficient markets and economically rational individuals, such possibilities will have been anticipated by the parties involved and all such agency costs of debt, and will be reflected in the prices and other characteristics of equity and debt securities and managerial contracts since a similar line of reasoning underpins the agency cost of debt. For example, the cost associated with the separation of ownership from control. Many of the wealth effects of financial structure decisions will not have been anticipated by stakeholders, and therefore, in practice, many corporate decisions will inevitably involve contractually uncompensated wealth transfers. This would seem to imply that not all agency costs of debt will necessarily be borne by shareholders. In contrast, the agency costs associated with debt finance appear to have been less of a concern to a corporate governance reformers. Nevertheless, the agency costs of debt can be substantial and unanticipated, and capital structures that increase the probability of default can have a severe adverse impact upon the financial claims and total wealth of other stakeholders. In the following section of this chapter, we examine that finance researchers have had to say regarding the capital structure decisions and how leverage may or may not impact on the firm value and the riskiness of different stakeholders' financial claims. The conflicts of interest generated by a leverage decisions and the ways that managers, if they were actually motivated to act in shareholders' interest, could attempt to shift uncompensated risk onto other stakeholders are then examined from an option pricing perspective. Whether in practice the economic welfare of other corporate stakeholders claims are adequately protected by set of legal, regulatory, and governance arrangements typically available and utilized by stakeholders. This analysis suggests that if the reliability of a firm financial information disclosure is assured, most reasonably diligent debt holders can normally be confident that their contractual claims can be adequately protected via legal contractual means. However, we emphasize that firms are by nature risky and rapidly changing economic conditions and the incentives of corporate and financial entrepreneurs are continually exposing the firm to a new incalculable risk. So let's proceed to capital structure and financial risk. Capital structure refers to the manner in which firms are financed. Firms may raise funds from external sources or plow back profits rather than distribute them to shareholders as dividends. While financial risk is any various types of risk associated with financing, including financial transactions that include company loans in risk of default. Often it is understood to include only downside risk, meaning the potential for financial loss and uncertainty about its extent. So let's talk about equity finance and debt contract. Equity finance is a security with no maturity date and which makes no explicit cash flow promises, while debt contracts have maturity date and normally require the firm to pay out regular fixed interest and capital repayment irrespective of the success or otherwise of the firm's investment project. That creates additional risk via leverage, and the higher the debt relative to equity finance, the greater is this financial leverage. So let's proceed to the capital structure. So here we can, as we as can be seen in the figure, the respective payoff functions to shareholders and debt holders are therefore analogous to that of a call option holder and the writer of a put option on the underlying value of the firm and with the strike prices equivalent to the value of the outstanding debt obligations. As discussed, the distorted incentives associated with high leverage and limited liability may also encourage corporate decision-makers to maximize any leverage effects by altering the compositions of the firm's assets and/or the riskiness of its cash flows. The proposition that managers always act in shareholders' interest and that the convexity in the shareholder payoffs at high debt levels may result in expropriation of debt holders is one of the major insights to be derived from the application of option pricing ideas to corporate securities. So to talk more about the financial structure and corporate governance, let's proceed to my other group mates. Thank you.
Hello everyone, I am Ratsan Anvakilar, and now I will be talking about the topic Does capital structure matter? First off, does financial leverage number 1 create value? Number 2, simply increase the financial risks and fair returns to shareholders? Or 3, encourage shareholder managers to shift uncompensated risk onto debt holders? These questions were raised when the famous irrelevance theorem was published. But to understand the context of what I'm talking about, let me give a brief introduction on what capital structure is. Capital structure is the way a corporation finances its assets through some combination of equity, debt, or hybrid securities. It refers to the makeup of a firm's capitalization. In other words, it is the way on how the company raises money, whether it is through issuing new stocks to investors, through obtaining loans and issuing bonds, or a hybrid of both. So, the proponents of the irrelevance theorem were first Franco Modigliani. He was an Italian American economist and a professor at the University of Illinois, Carnegie Mellon University, and MIT Sloan School of Management. The second one was Merton Miller, who spent most of his academic career at the University of Chicago's Booth School of Business. So, what is the irrelevance theorem or the M&M theorem? According to Modigliani and Miller in 1958, in a perfect and complete market setting with no transaction costs or taxes, how the firm is financed will have no effect upon its value. Thus, capital structure is irrelevant in respect of determining firm value. So, whether the firm is financed majority by debt or majority by equity is independent on its value. In other words, the irrelevance theorem argues that the way a company finances its operations will have no effect on its firm value. So, what determines the firm value then? According to the M&M theorem, first is the size, and two is the riskiness of the cash flows arising from its investments in risky projects. The first one refers to a company's ability to earn revenue, while the second one refers to the risks associated in its underlying assets. Of course, the M&M theorem has several challenges. The first challenge is the perfect and complete market. It leaves out a host of highly relevant institutional features. Of course, in a perfect market, there are no problems. There are healthy competitions and everything is running smoothly. However, this is certainly not the case in the real world. So, this assumption of a perfect market is irrelevant to the understanding of the financing decisions of actual companies that are operating in realistic market setting. The second one will be related to corporate governance. The M&M theorem will render corporate governance to be irrelevant because all corporate stakeholders could equally well directly contract with each other via market transactions. And in this setting, the economic reasons for the existence of the corporate form would be unclear. The last one would be the corporate debt interest tax shield. Corporate debt interest tax shield refers to the reduced income taxes brought about by deductions to taxable income from a company's interest expense. Debt interest tax shields encourage firms to finance projects with debt since the dividends paid to equity investors are not deductible. And because of the tax advantages of debt interest payments, firm value would now be maximized at almost 100% debt finance, so this would result in the equity shareholders perceiving a higher risk to the company. This possibility of default and or excessive risk taking by shareholders because in their model they assumed that both parties had free access to the actual future cash flow distribution of the firm and hence could avoid investing in firms that might subsequently default. But in reality, this is not possible because investors don't have access to such information. In summary, Modigliani and Miller's irrelevance theorems argued that capital structure has no effect on the value of the firm, and this was faced by different challenges: its assumption of a perfect market, the irrelevance of corporate governance, and the corporate debt interest tax shield. So, with the relative amounts and types of debt being used in relation to the risk of firms' operations, financial distress costs, and other agency related factors, empirical studies have found that firms have typically stable intertemporal capital structures. And as most firms have debt, suggestions arise that there might be a firm specific optimal capital structure. In relation to this, post-Modigliani and Miller studies have developed models of optimal capital structure which involve maximizing the value of the firm in the context of a trade-off between the tax shield advantages of debt and or the agency costs of equity. So, that would be all. Thank you so much for listening and let's proceed to the next topic.
Hi, I'm Charmaine and Valentine. and I will be reporting about the agency cost of debt. The agency cost of debt refers to an increase in cost of debt when the interest of shareholders and management diverge in a publicly owned company. The most influential capital structure model is that developed by Jensen and Maclean in 1976. In a world without corporate taxes but with costly contracting and non-trivial agency costs, ownership and capital structures were not independent of each other, but rather were chosen so as to minimize total agency costs. At the center of the Jensen and Maclean model is the potential for exposed wealth transfers from debt holders to shareholders arising from the so-called asset substitution problem. How can debt holders stop shareholders from using their funds on a more risky project than originally claimed when the contract was negotiated? Jensen and McLean assumed that all economic agents are rational contractors and that financial markets are efficient. They argue that these and other possibilities for expropriation will have been anticipated by all concerned, and thus all agency costs are ultimately borne by shareholders, and assumes that the agency cost of equity decline as the proportion of debt increases. Meanwhile, the agency cost of debt also increases as debt levels rise. The pioneers in the development of agency theory and what has been subsequently become known as optimal contracting. For most large firms, the direct costs of bankruptcy are generally a relatively small percentage of firm value. On the other hand, indirect costs are often far more significant, and firms can suffer costs of financial distress even when bankruptcy is ultimately avoided. These costs reflect the conflicts of interest between shareholders and debt holders and the option like incentives of leverage equity, particularly when the firm is in or close to financial distress. Several studies have examined other ways that corporate managers acting in shareholders' interest may attempt to increase and shift business risk onto other stakeholders. The so-called underinvestment problem by Myers in 1977 provides an indication of the distorted incentives that may arise when a firm is in financial distress. Basically, shareholders could lose if the management invests in a positive net present value project and then the firm subsequently becomes bankrupt. Under these conditions, the benefits of the project accrue to the debt holders and other creditors. Another value-destroying initiative that management could attempt is the launch of a new project which, even though it may have a negative net present value, it could still increase shareholder wealth by more than the money invested if it is sufficiently risky. This is because for every risky investment undertaken by a firm with a significant risk of default, shareholders benefit if a more favorable outcome is actually realized, while the cost of unfavorable outcomes is borne by bondholders. For a firm in danger of default, shareholders can be expected to put pressure on managers to declare a large dividend so that they receive a large proportion of the firm's remaining assets. A large lump sum dividend ensures that the shareholders get a substantial proportion of the firm's value, and therefore, when the debt holders take control subsequent to the firm defaulting, the latter will be left with little more than an empty shell of a company. If debt holders and other creditors become aware of the financial distress, then they can be expected to anticipate the said motivations and risks to their financial interest. Creditors will attempt to take actions that limit the ability of managers and shareholders from engaging in behavior that shifts the risk or cost associated with possible bankruptcy onto them. Hence, managers and shareholders have a common interest in keeping bad news about the firm from becoming public. These conflicts of interest are severe only when the company is in or close to financial distress. The consequences of these high leverage related actions can be very costly to some stakeholders and also very costly to safeguard against. What has now become the orthodox view of optimal capital structure as the firm balancing the present value of interest tax shields and the falling agency costs of equity against the rising agency cost of debt and bankruptcy or financial distress cost. The agency cost of debt can, however, be substantial given the opportunities and financial incentives of shareholders to take actions exposed that can have significant negative wealth consequences for the lenders. Thus, agency costs are ultimately borne by the shareholders.
Hi, my name is Queenie Ann Vidamenos, and I will be reporting about incomplete contracting and the residual claimant status of other stakeholders. As to what Hart state, corporate governance, or how the discretionary actions of executives are exercised in a manner consistent with the interests and rights of other stakeholders, is of economic importance only in a world characterized by both agency cost and incomplete contracts. The notion of incomplete contracts refers to the circumstance that some aspect of contractual parties pay off relevant future behavior, or some relevant payoff in future contingencies is unspecified in the contract or unverifiable by third parties. It exists whenever the contracting parties are unable to fully specify the actions to be taken in every possible future state of nature. And one example of this is a long-term labor contracts that do not fully specify an employee's duty. With such contracts, it is implicit that the employee will be frequently required to undertake activities which, due to the inability to specify what these will be, not explicitly detailed in the contract. As to what I have read, incomplete contracts may be attributed by three different causes. First, high enforcement costs entailing unverifiability by third parties such as courts or arbitrators. Second is the transaction costs that arise from the uncertainty about future events. And finally, from asymmetric information. This incompleteness exists despite the fact that at the time of writing a contract, that parties are able to incorporate their expectations regarding the most probable future events that are likely to materially affect their interest. According to the residual claimant theory, after all factors of production or service have received their remuneration, the party or agent supposed to receive the left or residual amount is known as the residual claimant. This residual claimant receives the remainder of the sum after all costs have been accounted for. The residual claimant need not be the same person all the time. Next. Kay and Silverton argue that the recent governance reforms have failed to take fully account the implications of incomplete contracting, namely that large public companies are much more than simply a set of legal contracts. Such firms are made up of several stakeholder groups, each with legitimate interests and concerns. It was predicted that under incomplete contracting environments, the optimal allocation of residual claim for firms participating in global production depends on the relative position at which the supplier enters the sequential production and on the demand elasticity faced by the final good producer. And in an incomplete contracting world, executives cannot act solely in shareholder interest. They have discretion, and no one other than a shareholder would be willing to contract with an organization in which all managerial discretion is exercised in the interest of other party. So, what is required here is a system which views executives as trustees of the company, which is a social institution, and which requires them to consider the interests of the firm itself and all its various stakeholder groups. That's all. Thank you.
Hi, I am Maria Michaela Maglangit and my topic is the employee as residual claimants. So before we proceed, let us first review agency costs. So there are two types of agency cost. First is the agency cost of debt, which is defined as the increase in the cost of debt of an organization. This happens when there is a conflict between the shareholders and the debt holders. The debt suppliers, in order to protect themselves from the ongoing conflict, take preventive measures in the form of higher interest rates. Next is the agency cost of equity. This is defined as the conflict of interest that arises between the management and the shareholders. This happens when the management diverges from the interest of shareholders, and for any reason, the shareholders have to bear the cost. So from this, we can gauge that agency cost of equity is the cost involved to keep a track on management's decision by the shareholders. Looking at these definitions, we can say that agency costs are ultimately borne by the shareholders, as this can be anticipated, priced, and guarded using covenants. However, this is not the case for employees, as they are highly susceptible to firm-specific risks, and even without the means to guard themselves from this risk, in contrast to equity and debt holders. So why exactly are employees considered as residual claimants? They are considered as residual claimants because, as a class, they gain when the firm prospers and loses when the firm suffers. One concrete example of employees being residual claimants is them being members of a defined benefit pension scheme. So a defined benefit pension scheme is defined as an employer-based program that pays benefit based on factors such as length of employment and salary history. Being a member of a defined benefit pension scheme increases employees' exposure to higher level of long-term firm-specific risks, as their pension depends upon the sponsoring firm. The basic problem is that firms are inherently risky, and employees who are members of the pension scheme depend upon the firm both in staying in business and in not taking risks that may jeopardize its ability to honor pension obligations. This is why members are more exposed to high levels of long-term firm-specific risk, as when there is a shortfall in resources of funds, the pension members are actually not even going to be classified as unsecured creditors, nor entitled to a share in the firm's other assets. So when pension schemes are in deficit, this results to conflict of interest between shareholders and employees. In this instance, the entity's internal governance system and the value it places on its relation with employees will be crucial for the entity on determining whether to close down or to continue the pension scheme. Regardless, members of the pension scheme are already more exposed to firm-specific risk than they already are as employees. That ends my topic, and thank you for listening.